Good evening, everybody, and welcome to another week of technical analysis for GameStop. This week we'll be looking forward for the week of 7/19 through 7/23. As you all know, last week we were looking at a cup and handle formation. It has broken down. I'm officially willing to declare that. There was a few reasons, and I think this is maybe a good learning opportunity as I see a mistake I made in the prediction and possibly a learning opportunity for you guys at home. The first thing was the share offering uh, was sold much more rapidly than the initial share offering. So the first one of 3.5 million was sold over a period of 15 trading days, and this share offering of 5 million shares was sold over a period of 9, which caused a much more drastic decline in price. Um, this offering was 1.5 million shares more than the previous one, and the Russell 1000 rebalancing was occurring in the background while all this was going on. And due to those reasons, I kind of incorrectly estimated GME's rate of descent on this dip before we came back up again. I presumed a low of 194. We sank about $43 below that. And much of this was due to the abundance of in the money puts purchased last week by short hedge funds. Also underestimated the amount of capital that they would be willing to deploy for such a move. As you can see here, if we look at the top three ETFs and GameStop, top three ETFs containing GME and GameStop, you can see there's about $1 billion in the money puts bought last week. And what this causes is delta hedging from the market maker as they attempt to remain delta neutral on these options. They will sell shares at market as these options go into the money or near the money, effectively naked shorting the stock. Here we can see the failure of the cup and handle. This is our first at the money offering, signified by these two purple lines. This is when it was announced. This is when it was closed. Here we have our second. And as you can see, the trend after the end of the announcement is down. But this time it was down significantly more. I kind of predicted we would end here, right around this, I think it was right around the 12th. And instead we in fact dipped quite a bit lower. Anyway, that's the failure of the cup and handle on the 1 day timescale. Thankfully, I like to look for supporting trends when I do technical analysis, and this entire cup and handle formation, as you all well know, was supported by an ascending triangle, which we can see here. And if we open this up, we can see that we have our long-term trend line starting here, with our bounce here on Thursday. Here's our resistance at 180, a resistance at 225.20 at the money offering. We have a resistance at 300 and another resistance up here at 350. And this is the one we're really looking to break for a short squeeze to kind of fire off. Something else I noticed while going through kind of drawing this out and mapping it was 180. 180 has been a really interesting resistance. We fought for it for months. It was impossible to clear, and then boom, in June we ran up and we came back down below it. I know everybody has PTSD from the last time we were in this situation, but I kind of have good news for you. It looks like our bounce on that trend line is signaling a break to the upside. We have a few other indicators that we're going to look at that signal decent bullish momentum. And every time we've broken through 180, historically, we have tested 350. If we have broken through and cleared it on a significant uptrend, we have tested 350. So if we break through this time, we should test 350 again. And that's kind of what the cup and handle was predicting anyway, is that third test at 350. So we'll see if that comes to fruition this week. Another interesting thing I found was that if we anchor VWAP to the run up in February and kind of cut out the noise over here from January, you can see that there was some buying pressure here, but then apes have not sold a share. In fact, there was just some more buying pressure in June, which brought the price up, or the volume weighted price up. And now we're right here, and we're actually just trading about $10 below our volume weighted average over the course of this year. Um, so that could also signify like a break to the upside of that would give us a lot more room for upward potential. Currently it's sitting at 177.33. I expect we will break through it Monday or Tuesday. I'll go into a couple of reasons for that. The first being that the market makers are going to be deleveraging out of those positions from last week. We know about the 440,000 out of the money puts. Additionally, we know about the in $1.3 billion worth of in the money puts. And we can expect to see them starting to buy back to cover those naked shorts on T+2 from Friday, which will be this Tuesday. As all the other indicators are kind of pointing to this Tuesday as well. If we take a look here at our MACD, you can see on the daily that we're about set for a crossover to the upside. We've already actually crossed over on the 4-hour right here. We crossed over Thursday on the run up from that low of 151. We're now up $21, I believe. $19, sorry. And it may take like a couple days for us to see that reflected on the daily MACD, but it is looking primed for a crossover. We've already broken out of BBKC. That happened last week. So we can expect more volume and volatility moving forward through this week. Additionally, I want to talk about Stoch RSI. If you guys want the definition, you can check it out on Investopedia. Essentially, it's an oscillator that moves between oversold and overbought. Currently, we're drastically oversold, almost a year low, the lowest we've been since February. And we've just had a KD crossover, which is this K percent signal line crossing over this D percent signal line. And this indicates a momentous shift to the upside. It's a buy signal. This in combination with MACD is quite reliable. Oversold is up here at 20, and then overbought will be up here at 80. So we have quite the range to clear to the upside for this signal to hold out. Lastly, I wanted to talk about the SPY. This week on Friday, we saw a downtrend entering that upper possible correction zone. If we fall into the blue zone at around $426, we could see a rapidly descending price action on the SPY down through zones 2 to 3 or 4 possibly. Remember, at any time this can turn around and bounce, but if we drop below zone 4 at $390, I would predict a massive sell-off or crash of the market. I bring this up every week, not so you can play the SPY or short it, but so you have an idea of what's going on in the broader market at large, how this correlates to GME, and the fact that if the market crashes, we could see margin calls come in on lots of positions everywhere. So I feel like this is very relevant, and let me move my head so you can see that last correction zone. There we go. And yeah, also another indicator for the market is the Shiller PE ratio, or the PE10. As we can see, it's 37.99 this week. It's down about 37 points from last week, but that's because of the 2 red days we saw at the end of this week. So midweek, it would have been up from this number. This could also be a sign that the market is beginning a downtrend. I'll be watching these closely every day, as always. Thank you all so much for tuning in, and I will see you bright and early tomorrow morning at 9 a.m. Thank you, and have a great night.